The hotel industry is poised for an upcycle. Lemon Tree has a healthy pipeline of room inventory, both owned as well as managed, and is well positioned to capture the increased demand trend. The stock has also been added to the MSCI India Small Cap Index from June 2022, which augurs well. We remain bullish on the hotel chain and advise investors to add the stock. Lemon Tree's Q4 FY22 performance was affected by the third wave of COVID-19. Revenue declined 17% QOQ. Occupancies declined to 46.1% in Q4 compared to 57.6% in Q3 FY22. While occupancies declined, average room rates grew marginally by 5% QOQ. Lemon Tree did not lower the price in January 2022 due to Omicron, which supported the overall ARR. EBITDA margins declined from a high of 44% in Q3 FY22 to about 31% in Q4 FY22, mainly affected by the drop in top line. It also witnessed a marginal uptick in employee and other expenses. Lemon Tree had an exceptional charge of 15.2 crores in Q4 FY22 owing to provision of one-time stamp duty expenses on amalgamation of 3 hotels with a subsidiary of the company. Its net losses widened during the quarter. As the third wave receded, demand improved. Lemon Tree's occupancies rose in 6 weeks, reaching a level of 60% in March 2022. While the leisure segment maintained growth momentum, business and corporate travel, as well as meetings, conferences, and events resumed in a big way. Lemon Tree, which sees highest demand from the corporate segment, saw a huge pickup in demand. Average room rates, which were 90% of pre-COVID levels, have increased to 120% of pre-COVID levels in May 2022. Lemon Tree has guided for doubling of revenues over FY22 levels in the current fiscal, implying a strong growth over pre-COVID FY20 as well. Room additions were affected during COVID, with room inventory growing by a mere 6% in the last 2 years. However, Lemon Tree has planned strong room additions to effectively tap the demand upcycle post 2 years of COVID. It aims to reach 10,668 rooms by FY25, a 26% growth from FY22 level. Managed rooms would see a higher growth of 44% to reach a count of 4,738 rooms. Lemon Tree would increase the share of rooms under management contract from 39% to 44% by FY25. Lemon Tree has considerably reduced the cost structure by optimizing manpower as well as power expenses, which form the bulk of the fixed costs. Also, the company has reduced the corporate and other overhead expenses. The company states that its costs now stand at 1 crore rupee a day, assuming overall occupancy of 75%. Current costs are about 15 to 20% lower than pre-COVID levels. With demand improving and costs reducing, Lemon Tree expects margins to improve. Its Q3 FY22 margin reached 44%, which is higher than pre-COVID levels of Q3 FY20, despite Q3 FY22 revenues being about 30% lower than that of pre-COVID levels. Lemon Tree has guided for EBITDA margins of 50% in the current fiscal. Smaller hospitality players were significantly affected over the past 2 years, and Lemon Tree expects supply in the hotel industry to remain constrained over the next 2 to 3 years. Demand is expected to return strongly as corporate travel is picking up. Also, as restrictions on international travel have been removed, there would be an increase in inflow of foreign tourists. Lemon Tree expects demand to grow at 11 to 12% CAGR over the next 3 years. Meaningful supply addition would take 2-3 years to come on ground. Demand-supply imbalance over the next few years would have a favorable impact on ARR, thereby benefiting existing players like Lemon Tree. At the current price, the stock is trading at EV/EBITDA of 17 times its FY24 projected earnings. Valuations are at discount to historicals, and we expect a re-rating.